Welcome back to the channel. Today, we're diving into a critical topic for investors, the S&P 500 lost decade. We'll explore what it is, how it impacts your investments, and how you can prepare for such scenarios. So, let's get started. First, let's define the S&P 500 lost decade. This term refers to a long period of over 10 years where the S&P 500 stock market produces flat to negative returns. The first lost decade started around the 1970s and marked a period now known as the Great Inflation. During this period, the S&P 500 lost close to 50% of its value across a 20-month period, and generated a mere 0.1% annualized returns over more than a decade. The second lost decade started around the 2000s, ending in the Great Recession. In this period, the S&P fell 49.17% from its high in October 2007 before bottoming out in March 2009 and generated a mere 0.04% annualized returns over more than a decade. So, what causes a lost decade in the stock market? Here are a few key factors. Market overvaluation. Often, markets become overhyped, leading to inflated stock prices that can't be sustained. Economic recessions. Economic downturns lead to lower corporate earnings, impacting stock prices negatively. Investor sentiment. Fear and uncertainty can lead to panic selling, further driving down prices. External shocks. Events like geopolitical tensions or natural disasters can also play a role. Interest rate changes. Rising interest rates can lead to higher borrowing costs, negatively affecting both consumers and businesses. Now that we understand what a lost decade is and what causes it, let's talk about how to prepare. Here are some strategies you can employ. 1. Diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes like bonds, real estate, and international stocks to mitigate risk. 2. Focus on quality. Invest in high-quality companies with strong fundamentals. Look for companies that have a solid track record, low debt levels, and consistent earnings. 3. Stay disciplined. Stick to your investment strategy and avoid making impulsive decisions based on market fluctuations. 4. Emergency fund. Maintain an emergency fund that covers 6 to 12 months of living expenses. This will give you peace of mind during market downturns. Here are some investment options you might consider during a lost decade. 1. Bonds. Government and high-quality corporate bonds can provide stability and income when stock markets are volatile. 2. Dividend stocks. Look for good fundamentals companies with a good history records of paying dividends. These can provide a steady income stream even if stock prices aren't rising. 3. Real estate. Real estate can be a good hedge against inflation and provide passive income. 4. Precious metals. Gold and silver often retain their value during economic downturns and can serve as a safe haven. Now, you might be wondering, why should I invest at all during uncertain times? Here's why. 1. Long-term growth. History shows that markets eventually recover. By investing, you position yourself for potential gains when the market turns around. 2. Compounding returns. The sooner you invest, the more you can benefit from compounding returns over time. 3. Opportunity to buy low. Market downturns can present buying opportunities for quality stocks at discounted prices. In conclusion, while the S&P 500 lost decade serves as a reminder of market volatility, it also teaches us valuable lessons about preparation and strategy. Diversifying your investments, focusing on quality, and maintaining a long-term perspective can help you navigate challenging times. Hope you found this video useful. Don't forget to give it a thumbs up, hit that subscribe button and turn on notifications. Thanks for watching, and I'll see you in the next video.